Investing in Class A multifamily. Hey everyone, welcome to this week's video. First of all, apologies about the technical difficulties. Don't have camera showing today, but gonna just use the audio and the slideshow. So today we're gonna talk about Class A multifamily. On this channel, we've talked a lot about mostly value add properties, which are Class C, Class B. You do some renovations, raise the rents up. For Class A, we're talking about a very, very different product. This is newer buildings, good areas, really solid and reliable tenant base, just overall nicer. Of course, it comes with a premium. And if you were anything like me when I got into multifamily for the first time, you're probably looking at some of these cap rates and wondering who on earth is buying these Class A multifamily buildings. So today we're going to go through a few of those reasons, what people are seeing in the market, why people invest in Class A instead of value add. And this will be in relation to value add deals, so keep that in mind. So the first thing we have is limited downside risk when compared to value add properties. So we're looking at newer builds. They've typically got less deferred maintenance. You have a good tenant base who's more reliable. So you don't have no downside risk, but your downside risk is typically limited. So this is a really good thing for investors, especially conservative institutional investors. Think like pension funds, insurance companies, just high net worth individuals. They're looking to limit their downside risk. And Class A multifamily is fantastic for that. In fact, Class A multifamily is kind of known as, the corporate bonds of multifamily and real estate investing to give you an idea of where it sits on the risk profile. The second thing we have is higher value multiples, which means lower cap rate. So remember, lower cap rate means more expensive. So you actually get higher multiples per earnings. So let me break this down. Example I like to use is a multifamily building is just like a business. It has earnings, has income, has expenses. A business has something called EBITDA, which is its earnings effectively after expenses and removes a whole host of other items. But think about EBITDA as just the earnings of a company. The actual value of the company is rated by a multiple. So you're going to have, say, a business earns $1 million a year after expenses. If that type of business has a 10x multiple, the value of the business is actually $10 million. If that next year the business increases the income to $2 million, that business will now be worth $20 million because it has that 10x multiple. When it comes to multifamily investing, lower cap rates means higher multiples. So if we're looking at a 5% cap rate building, which is probably the entry level to Class A, we're looking at a 20x multiple on earnings. So if a building is producing $1 million in income and it's a 5 cap building, that building is worth $20 million. Now, if it's a 4 cap building, it's a 25x multiple. That is the value of the building. To give you an idea, this is kind of a similar philosophy to price per earnings if you're looking at the stock market. So I just looked a little earlier. You look at Nvidia, that has a price to earnings ratio of 40. That means the stock actually costs $40 per each dollar of earnings for each share. So you could actually look at multifamily Class A even and say, this is actually pretty good value. Even if if it costs 20 to 25 dollars per dollar of earnings, it's actually pretty good value compared to a lot of the stock market right now. Another example is Apple was $33. Um, AT&T was 26, I believe. So generally, even the best multifamily is still seen as better value than most of the stock market. So keep that in mind because there is some crossover when we look at the investor and their capital. So keep that in mind. Higher value multiples, lower cap rates. With Class B and C, you're typically dealing with higher cap rates. So you might see a 12 and a half multiple, which would relate to an 8% cap building. Next one is returns driven, not PPU. In a lot of value add, we'll often talk about price per unit. Now, if you've been following me for a while, you'll know that I'm not a big fan of price per unit as a metric, but it is used, especially on the lower end of unit counts, 6, 8, 12, 18 units. A lot of people are going to quote price per unit. In Class A, typically we're looking at returns, cap rates, cash flow, what's driving the value, not so much PPU. They'll mention it, but it won't really play a huge factor in actually investing in Class A multifamily. Limited efficiencies upside. So we have the ability in value add to come in, and usually they're individual investors that own these buildings, and the variation of management can vary greatly. So you might have an owner who is mismanaging the property, not really doing a great job, and you might come in and find that there's a lot of expenses you can cut out and rents that you can push up. So there's a lot of inefficiencies in value add that can be taken advantage of to drive the value of the property. In Class A, you're typically going to be dealing with very high level professional outfits managing these buildings. So you're not typically going to find these efficiencies that are able to really maximize and force that appreciation on the value. So it's a very tight number game in the Class A space. And if you're thinking that, hey, you're going to buy something for 20% below market with 20% below rents, it's almost unheard of in the Class A space. Definitely you can have exceptions, but it's much, much more rare than in the value add space. Class A multifamily is very focused on market and analytics. So they will focus, the investors will focus on median incomes, population growth, what the major industries are in the area. And a lot less emphasis is put in the value add space. In value add, your value is forced appreciation, which is bringing rents up to market level. You can make value add work in an up market, in a down market, in a middle market, because you have specific metrics of rents from where they are to where you can get them to. In Class A multifamily, you don't have such ability to just raise rents on a whim or have that physical value add. So you have to speculate on where rents are going to end up in the future. And to speculate on that, you need to use data and you need to have a good sense of where rents can go. And that means that you're really looking at a lot of data, a lot of statistics, what's currently out there in the market and what could be in the future. So you will see a lot more of that in Class A than in value add. Competition from new development. Class B, Class C is usually older product. When a new building gets built next to a Class B and Class C, that's usually a good thing. It means that the area is rising. You always want to be, the worst property on the block. That just allows for that rent growth to go up. But those Class B and C properties aren't in direct competition with a Class A. They're going to be different tenant bases. However, when you own Class A buildings, new development will actually provide competition and usually better competition than what you have, because you got to remember the development is going to be brand new. There's going to be probably better amenities, better quality construction, as technology increases, people always want to be in the newer and better buildings. So new development plays a big role in investing in these kinds of properties, and it can definitely, when there's oversupply, it can really impact the Class A multifamily market, whereas the same comparison can't be made in Class B and C. Last one I have here is you're at the mercy of the rental market. In Class A, there isn't a ton of opportunity to force those rents up or force that appreciation. So oftentimes you are at the mercy of what the rental market does. If the rental market slows down, if there's a huge supply of inventory, there's really nothing you can do. You just better hope that you believe in your metrics, you believe in the purchase, and you got it at a decent enough price that you can weather the storm if a storm does come. But at the flip side, if it works out well and you're on the upswing of a market, you don't have to do almost anything. You just have to keep running the building, and the appreciation will be huge. Remember, we have those big multiples on Class A multifamily. So you are at the mercy of the market. If the market takes a downturn, you have really nothing to do. You could either cut your losses and sell, or you can just try and weather it out and wait till the next upswing in the cycle. It could be years down the road. So there's not a lot you can do to change the trajectory of a Class A multifamily building. It is what it is. So those are some of the upsides and downsides of Class A multifamily. It's a very different world to the value add space, even though someone might look at it and be like, oh yeah, they're just nicer, newer properties, but very different styles of investors, very different capital, and a very different approach as well. But if you can understand some of these, it can help you all across the board. So that's all we have time for this week. Thanks for tuning in, and we'll see you next week.